In this video, we're going over the 6 best monthly dividend ETFs, and while most dividend ETFs pay you a dividend every quarter, the ETFs on this list pay you dividends every single month. And I picked the 6 that I think are great value for your money, so let's get right to it. The first ETF is SPY-I, the NEOS S&P 500 High Income ETF. This fund seeks to generate consistent high monthly income in a tax-efficient manner with the potential for capital appreciation. The targeted benefits of SPY-I's strategy include generating high monthly income from investing in the S&P 500 and using a call option strategy. It also takes advantage of tax loss harvesting opportunities along with index options, which are taxed favorably. And third, this fund utilizes a call option strategy that may include both sold and bought S&P 500 index options. For dividends, SPY-I has a dividend yield of over 12%, which is paid out monthly. And while this fund is not that old, it's shown some positive dividend growth so far, which is nice to see. SPY-I contains a total of 511 holdings, with its top holdings in companies like Apple, Nvidia, Microsoft, Amazon, and Google. And the sectors that make up this fund include technology, financials, and healthcare. This, along with the holdings, are very similar to what you'd find with a fund that invests in the S&P 500 like VU. As for the cost, SPY-I comes in a little bit high here with an expense ratio of 0.68%. The returns for SPY-I over the past few years have been great, with annualized total returns of over 13% since its creation in 2022. Looking at the performance of VU and a solid dividend ETF like SCHD, since SPY-I's creation almost 3 years ago, it's definitely given some good returns. SPY-I gives you consistent and stable high monthly dividends with tax benefits. It offers great opportunity for long-term returns as well as some downside protection for income investors. The second ETF is JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. The objective of this fund is to deliver monthly income and exposure to the Nasdaq 100 with less volatility. It does this by generating income through a combination of investing in U.S. large-cap growth stocks and selling out-of-the-money Nasdaq 100 index call options, seeking to deliver monthly income from the stock dividends and the option premiums. When it comes to dividends, JEPQ has a dividend yield of over 10%, which of course is paid monthly. JEPQ contains around 108 holdings, and some of its top holdings are in popular names like Apple, Nvidia, Microsoft, Amazon, and Google. And it's exposed to sectors like technology and communication. These holdings and sectors are going to be similar to the Nasdaq 100. For the fees, JEPQ has an expense ratio of 0.35%, which is on the lower end when compared to other covered call ETFs, which I'll explain more on what these are later. Since this fund has only been around since May of 2022, it doesn't have a long history of returns, but since its creation, it's had annualized returns of around 15% when you consider the price appreciation and dividends. And you can see how well JEPQ has performed since it's been around compared to the S&P 500 and SCHD, almost coming out on top over VU. JEPQ is a great ETF if you're looking for some consistent income and solid returns and exposure to the Nasdaq 100 with less volatility. This next ETF is DIVO, the Amplified CWP Enhanced Dividend Income ETF. This fund is an actively managed fund that's made up of high-quality, large-cap companies that have a history of dividend growth along with a tactical covered call strategy on individual stocks. DIVO seeks to lower volatility as dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. The strategy seeks to provide investors with an annual income of around 2 to 3% from dividend income and then 2 to 4% from option premiums. When it comes to dividends, DIVO has a dividend yield of 4.89%, which is paid out monthly, and for dividend growth, DIVO has had a relatively stable dividend growth over the last few years, which is nice to see. DIVO contains a total of 27 holdings, with its top holdings in companies like CME Group, Caterpillar, Visa, Goldman Sachs, and Honeywell. And the top sectors that make up this fund are financials, technology, and industrials. As for the fees, it comes with an expense ratio of 0.56%. DIVO has had some great performance with over 14% annually in the last 5 years and 12% since it was created around 8 years ago. And if we look at how it compares to some other great dividend ETFs, it performed very well. Even when compared to the S&P 500 returns of VU, it fared well for what it's meant for. Devo is a great dividend ETF if you're looking for reliable monthly income and to be invested in high-quality dividend-paying companies. And while it might not pay the biggest dividend yield, its conservative approach to its portfolio holdings allows it to help mitigate some downside risk and outperform a variety of other investments. This next ETF is QQQI, the NEOS Nasdaq 100 High Income ETF. The objective of this fund is to provide high monthly income in a tax-efficient manner with the potential for equity appreciation. The targeted benefits of QQQI's strategy include providing high monthly income from investing in a Nasdaq 100 and its call option strategy, the same tax loss harvesting opportunities like with SPY-I, and last, the call option strategy that may include both sold and purchased Nasdaq 100 options. QQQI has a dividend yield of over 14%, which is pretty incredible. And since this is a newer ETF, there isn't going to be much in dividend growth history, but since the past year since it's been established, the dividend payments have been stable. QQQI has a total of 107 holdings, with the top holdings being in familiar names like Apple, Nvidia, Microsoft, and Broadcom, with exposure to sectors such as technology, communication, and consumer discretionary. So nearly the same as what you'd find with the Nasdaq 100, leaning heavily on technology. Getting to the fees, QQQI is on the higher end here of the list with an expense ratio of 0.68%. The returns for QQQI have been pretty amazing with an annualized return of 18%, but keep in mind it was established just a bit over a year ago in January 2024. Relative to some other ETFs, QQQI has managed to perform well since its inception in 2024. And while this fund is a bit more on the aggressive side, despite the recent declines in the market, QQQI has consistently delivered stable monthly income, the potential for capital appreciation, and I'd say the opportunity for favorable market conditions in 2025. The fifth ETF is JEPI, the JP Morgan Equity Premium Income ETF. This fund's objective is to deliver monthly income and exposure to equities in the stock market with less volatility. JEPI's strategy incorporates actively selecting stocks along with selling out-of-the-money S&P 500 index call options to generate monthly income. For dividends, JEPI has a dividend yield of over 7% paid out monthly. JEPI contains around 132 holdings, with top holdings in companies like AbbVie, MasterCard, Progressive, Visa, and Amazon. And its top sectors are in tech, financials, and healthcare. Same exposure here that you would find for the S&P 500. Getting into the cost, this fund has an expense ratio of 0.35%. While JEPI has only been around since May of 2020, it's had some solid performance during this time, giving you an annualized return of 12%, accounting for dividends and appreciation. And while JEPI might not have crazy appreciation, you can see over the past couple of years, JEPI holds relatively stable even in uncertain market conditions compared to other popular ETFs. JEPI can be a good choice if you're looking for stable, recurring dividend income with some diversified holdings that can also weather uncertain times in the market. The sixth ETF, DGRW, the Wisdom Tree U.S. Quality Dividend Growth Fund. This fund seeks to track the investment results of dividend-paying U.S. large-cap companies with growth characteristics. DGRW's methodology screens for dividend-paying large caps with strong estimated earnings, return on equity, and return on assets, offering a strong large cap portfolio. For the dividends, DGRW's dividend yield comes in a bit low here at 1.56%, which is paid monthly. And while the dividend yield is low, DGRW has offered some decent dividend growth over this time with an annual dividend growth rate of 4.24% in the last 5 years. DGRW contains 303 holdings, and some of its top holdings are in stocks like Microsoft, Exxon, Apple, Procter & Gamble, and Chevron. And it's exposed to a variety of different sectors like technology, consumer defensive, and financials. It also comes with an expense ratio of 0.28%, making this fund the least expensive one on the list. DGRW has had some pretty great performance with annualized returns of around 16% over the last 5 years, and about 12% in the last 10 years. If we compare this with an S&P 500 ETF like VU, over the past 10 years, it's managed to match it up until 2020, and then tech helped pull away a gap from there on. Although DGRW does fall a bit short on the dividend yield, it gives you diversification, lower risk than the S&P 500, while also offering high levels of capital appreciation due to the holdings that make up the fund. And while this is a good fund on its own, I believe it's even better when it's paired with other dividend holdings in a portfolio. Okay, so now I want to switch over and talk to you about covered call ETFs. And you might be thinking, what's this have to do with these dividend ETFs? Well, many of the ETFs on this list, as well as other high-yielding dividend ETFs, are able to pay out those amazing dividend yields due to using what's called a covered call strategy. A covered call is an option strategy where an investor sells a call option on a stock that they already own, aiming to earn a premium. And the premium received from selling the call option is additional income for the investor. So these covered call ETFs will invest in a portfolio of stocks while also selling call options on the stocks in their portfolio. By doing this, the ETF is able to generate high dividend income for investors while also still giving you exposure to the underlying stocks in the ETF's portfolio, ultimately providing you with much more dividend income than you'd receive from non-covered call ETFs, which is a big plus for those income-focused investors. And if you're looking for more options for some great dividend ETFs, you can check out this video right here, or if you want to see what growth fund is the best, take a look at this one here. If you enjoyed the video, don't forget to tap that like button and subscribe for more content. I really appreciate you for watching, and I'll see you in the next one.